The incredible journey of Richard Dennis, the man who famously turned just $1,600 into more than $350 million in less than a decade. Yes, you heard that right. 1,600 into $350 million. And no, this isn't some fairy tale or a quick luck casino story. This is a real-life example of discipline, risk management, and a trading approach so powerful that it changed how traders all over the world think about the markets. Richard Dennis wasn't born with money, privilege, or connections. He didn't walk into Wall Street with a silver spoon. He grew up in a modest family in Chicago and got his start on the trading floor as a runner. Imagine that. A young kid running tickets back and forth on the busy, noisy trading floor just so he could stay close to the market action. But even in those early days, Dennis was different. While others were just doing their job, he was watching, studying, and learning. He had this deep belief that trading success wasn't about natural talent or genius. It was about following rules, having a clear system, and sticking to it no matter what. And here's the part that made him truly unique. He believed trading could be taught. Most people back then thought great traders were born, not made, that you either had the gift or you didn't. But Dennis disagreed. He believed that if you gave someone a good system and trained them to follow it with discipline, they could succeed just like he did. This belief eventually led him to create one of the most famous experiments in financial history, the legendary turtle experiment. Richard Dennis took a group of ordinary people, teachers, scientists, actors, even a professional blackjack player, and trained them in his trading method. The results were astonishing. Many of these so-called turtles went on to make millions themselves and became respected traders in their own right. But before we jump into that part of the story, let's go back and understand the exact principles Richard Dennis used to turn a small stake into a fortune. Because these principles are not just stories from the past, they are timeless lessons that every trader today can apply, whether you're just starting or already deep into the trading game. Principle 1. Risk a fixed percentage per trade. One of Richard Dennis's most powerful lessons was about risk. He understood something that many traders learn the hard way. Trading isn't about being right every single time. It's about staying in the game long enough to allow your winners to make up for your losers. And the only way to stay in the game is to control how much you risk on each trade. Dennis had a very clear rule. Never risk more than 2% of your total account on a single trade. Let's make this simple. If you have a $10,000 account, risking 2% means the most you can lose on one trade is $200. Even if you have 5 losing trades in a row, which happens to even the best traders, you'd still have around 90% of your account intact. That means you're still in the game, still able to take the next trade, and still able to recover when the right opportunity comes along. Most beginners fail because they break this rule. They risk too much, go all in, or use extreme leverage. 1 or 2 bad trades and their account is wiped out. Richard Dennis's approach was the opposite. He played the long game. His first goal wasn't to get rich overnight. It was simple. Survive first, then grow. If you take nothing else from this story, take this. Trading is a game of survival. Your first job is to protect your capital. If you stay in the game long enough, the big winners will eventually come. Principle 2. Cut losses quickly. Now let's talk about Dennis's second golden rule. Cut your losses quickly. Richard Dennis used to say something that might sound strange at first. Your job as a trader is to be a good loser. But there's a deep truth here. Losses are part of trading. They're unavoidable. What matters is how you handle them. If you let a small loss grow into a massive one, you dig yourself into a hole so deep that even a winning trade might not be enough to pull you out. Dennis believed the market always gives you a signal when you're wrong. And when it does, when price breaks below your stop loss or clearly proves your trade idea wrong, you don't wait, you don't hope, you don't pray. You get out immediately. Yes, this means you'll take many small, frustrating losses, but that's okay. Those losses are like paying rent, small, necessary payments that allow you to keep your spot in the market until that one big winning trade comes along that pays for everything. Think of it this way. Professional traders don't see losses as personal failures. They see them as business expenses. And just like any business, if you keep your expenses small, you can keep operating and stay profitable in the long run. So, there you have it. The first two principles that Richard Dennis used to build his fortune. Risk a fixed percentage per trade to protect your capital. Cut your losses quickly so small mistakes don't turn into disasters. These may sound simple, but they are the foundation of Dennis' success and the foundation of every professional trader's approach even today. Friends, now we come to one of Richard Dennis's most powerful lessons. Let your profits run. This is where so many traders go wrong. Most people are quick to grab small profits because they fear the market will turn against them. The moment they see their trade in green, they panic, close it, and then sit helplessly as the price keeps moving further in the same direction. Sound familiar? This is one of the most common mistakes in trading, and it's the very thing Richard Dennis wanted his students to stop doing. His philosophy was simple and beautiful. Markets reward patience, not panic. And he lived by this rule. When a trade is working in your favor, let it work. If the trend is strong, ride it for as long as it lasts. Days, weeks, sometimes even months. Because as Dennis taught, one big winning trade can pay for dozens of small losses and still leave you with a solid profit. Principle 3. Let profits run. Let's break this down. Imagine you take 3 trades in a row and lose $100 on each one. That's a $300 total loss. Then, finally on your 4th trade, the market moves in your favor. If you panic and take profits too early, locking in just $150, you're still down $150 overall. But if you let the winning trade run, if you have the courage to hold on and let the trend fully play out, that same trade could give you $600, $800, or even $1,000 or more in profit. Suddenly, instead of being down for the month, you are solidly profitable. This is why Richard Dennis always reminded his traders, a few big wins pay for many small losses. It's not about being right every time. It's about staying in the game long enough to catch those big moves. That's why patience isn't just a good quality in trading, it's an edge. Principle 4. Follow the trend. Don't predict. This principle is where Richard Dennis completely changed the way people approached the markets. Most beginners fall into the trap of prediction. They try to guess what the market will do next, call tops, call bottoms, time reversals, and usually they end up being wrong. Dennis didn't play that game. He believed you don't have to know where the market will go, you just have to follow it. If the market is going up, you go with it. If it's going down, you follow it down. It's about letting the market lead and you simply ride along. Dennis used a simple rule for this. If price was above the 200-day moving average, he only looked for buy trades. If price was below the 200-day moving average, he only looked for short trades. This simple filter kept him on the side of momentum, aligning his trades with the market's natural flow, and that dramatically improved his probability of success. Technical tools of the turtle system. Richard Dennis didn't just preach these principles, he turned them into a complete mechanical trading system. The beauty of this system was that it removed emotion and guesswork from the process. Here are the key tools he used. 20-period highest high, lowest low. This indicator tracked the highest and lowest prices over the last 20 periods, usually 20 days. When the price broke above the 20-day high, it was a breakout signal, time to go long. When it broke below the 20-day low, it signaled a potential short trade. This rule kept Dennis entering trades only when the market showed strong momentum. ATR, average true range, 20-period. The ATR measured volatility, basically how much the price moved on average. Dennis used ATR to calculate his stop-loss levels. If the ATR was $10, he'd place his stop-loss 2 ATR below his entry price, meaning $20 below. This gave trades enough breathing room to survive normal market fluctuations and avoided getting stopped out too soon by small pullbacks. 200 SMA, simple moving average. This was his most important filter for trend direction. If price was above the 200 SMA, Dennis only took buy signals. If price was below the 200 SMA, he only took sell signals. This ensured he was trading in harmony with the bigger market trend, not fighting against it. Example, a bullish trade step by step. Let's put all this together and see how a typical long trade might look using Dennis's rules. Trend check. The first step is to check if the price is trading above the 200 SMA. If it is, that confirms we are in an uptrend. Breakout confirmation. Wait for price to close above the 20-period high. This is your breakout signal, a strong sign that buyers are taking control. Stop loss placement. Place your stop loss 2 times in ATR below your entry price. This allows the trade to breathe while protecting your capital if the market suddenly reverses. Let the trade run. Stay in the trade as long as the market keeps forming higher highs and higher lows. Exit only when the price breaks below a key support level or gives a clear reversal signal. What happens if you follow this plan? You might take several small losses before finally catching a breakout that runs. But when that trend comes, and it always does eventually, you'll capture a large move. And that one big win can cover all those small losses and still leave you with significant profit. You've been stopped out 3 or 4 times in a row. You're frustrated. You start questioning your strategy, maybe even yourself. But then one day, you get another breakout signal. You take it, and this time, the price keeps climbing. It doesn't just move a little, it runs. Day after day, week after week, your trade grows larger and larger in profit. That moment when patience finally pays off is one of the most satisfying experiences a trader can have. And that's exactly what Richard Dennis wanted to teach. Trading isn't about instant gratification. It's about waiting for those big, powerful trends that change your entire month or even your entire year. Friends, if I had to sum up the secret behind Richard Dennis's extraordinary success in just one word, it would be this: risk management. Because here's the hard truth. No matter how brilliant your strategy is, no matter how many winning trades you catch, if you don't control risk, the market will eventually take everything back. Risk management was Dennis's shield, his safety net, and his greatest weapon. It was the reason he survived losing streaks and stayed in the game long enough to catch those massive life-changing trends. Fixed fractional position sizing, the secret to survival and growth. Dennis's golden rule was simple: never risk more than 1 to 2% of your total trading capital on a single trade. Let's break this down with numbers, because this is where the magic lies. If you have a $50,000 account, risking 2% means your maximum loss per trade is just $1,000. Even if you hit 5 losing trades in a row, you still have $45,000 left, more than enough to recover. But what made Dennis's approach so powerful was that he didn't keep risking the same dollar amount forever. He used dynamic position sizing, meaning as his account grew, his risk per trade grew proportionally. Here's what that looks like. Starting account, $50,000, risk per trade equal $1,000. Account grows to $60,000, risk per trade equals $1,200. Account doubles to $100,000, risk per trade equals $2,000. This is where compounding kicks in. Your winners start to snowball. And that's exactly how Dennis turned a small $1,600 stake into more than $350 million. He wasn't taking massive gambles. He was growing steadily, letting his risks scale with his account size. Pyramiding, the power of adding to winners. Here's where Dennis's system becomes truly fascinating. He didn't just take one position and sit back. When the market moved in his favor, he added more, carefully and strategically. This technique is called pyramiding, and it's one of the most powerful ways to maximize profits from a trending market. Here's how it worked. You take your first trade. Price moves 1 ATR in your favor, you add a second position. Price continues higher, you add a third position. Still moving up, you add a fourth position. By doing this, you end up having the largest exposure in your best trades, the very trades that are already proving you right. And here's Dennis's golden rule: never add to losing trades. This is where many traders go wrong. They keep averaging down, hoping the market will turn. Dennis knew this was one of the fastest ways to destroy an account. Instead, he taught his students to cut losers quickly and save their biggest size for their winners. Small losses are just the cost of business. One of Dennis's most famous quotes was, "You can't make money if you're afraid to lose money." And this is where mindset plays a huge role. He taught traders to see small losses as just another cost of running a business. No different from rent, electricity, or paying salaries. If you owned a shop, you wouldn't shut it down just because you had to pay rent this month. In the same way, small losses are simply the cost of staying in the market. They are your ticket to keep playing the game until the big trade shows up. When you see losses this way, you stop panicking and you stop abandoning your strategy too soon. The psychological edge. Mastering fear and greed. But risk management and position sizing are just one side of the coin. The other side, the harder side, is psychology. Trading is not just about numbers. It's an emotional battlefield. Dennis understood that fear and greed were every trader's biggest enemies. Fear makes you cut profits too early, leaving huge gains on the table. Greed tempts you to take oversized trades, over-leverage, and eventually blow up your account. His advice? Trust the process. He reminded his students over and over, you might face 5, 8, even 10 losing trades in a row. That's normal. The edge only works if you keep taking every single trade, even when it hurts. Most traders lose money not because their system is bad, but because they stop following it during a drawdown. Dennis taught his students to stay consistent because in the long run, discipline is what turns an edge into profits. The legendary turtle experiment, turning ordinary people into millionaires. And this brings us to one of the most legendary experiments in trading history, the turtle experiment. Richard Dennis made a bet with his friend, William Eckhard. Eckhard believed great traders were born with special instincts. You either had it or you didn't. Dennis disagreed. He believed that trading could be taught, just like any other skill. To prove it, he placed an ad in the newspaper inviting ordinary people to apply. Thousands of applicants responded, but Dennis selected just 23 individuals, including a security guard, a professional gambler, a scientist, and people with zero financial background. He trained them for just 2 weeks. In that short time, he taught them everything: risk management, trend following, stop-loss placement, and pyramiding. Then, he gave them real money to trade with and sent them out into the markets. The results were nothing short of astonishing. Within 5 years, this group, known as the Turtle Traders, generated more than $175 million in profits. Many of them went on to build successful trading careers and manage millions of dollars on their own. The experiment proved something revolutionary. Success in trading has little to do with talent or luck. It's about following a tested system with discipline, trade after trade, no matter how you feel in the moment. Why this matters for you now? Imagine this for a moment. You, sitting at home right now, with no Wall Street connections, no Ivy League degree, learning a system that could completely change your financial future. That's exactly what happened to the turtles. Ordinary people with no experience became millionaires because they were willing to learn, follow the rules, and stay disciplined. And that's the heart of this story. You don't need to be a genius to succeed in trading. You just need a plan, proper risk management, and the emotional strength to stick to it when everyone else is panicking. Friends, now it's time to pull back the curtain on the actual turtle rules. The exact step-by-step process Richard Dennis taught to turn regular people into millionaire traders. The beauty of this system lies in its simplicity. There was no room for second-guessing or emotional decisions, just clear, mechanical rules that anyone could follow. Turtle entry rules. The very first step was to get on the right side of the market. Trend filter, 200 SMA. Instead of guessing market direction, the turtles simply followed the trend. Price above 200 SMA, look for buys. Price below 200 SMA, look for sells. This single rule kept them from fighting major trends, a mistake that wipes out many traders. Breakout trigger, 20-day high-low. Once the trend was clear, they waited for a breakout. Buy when price broke above the last 20-day high. Sell when price broke below the last 20-day low. This ensured they only entered when real momentum was present, no chasing random noise. Stop loss, using ATR. Every trade was protected with a stop loss placed 2 ATR away from entry, giving it room to breathe. Position sizing based on risk. Each trade risked only 1 to 2% of the account. This way, even a losing streak couldn't wipe them out. Pyramiding, the secret weapon. This was one of the most brilliant parts of the turtle system. Every time price moved another 0.5 ATR in their favor, they added another position, up to 4 total. This meant they had their largest exposure during their most profitable trades, allowing one strong trend to cover multiple small losses. And the rule was clear: never add to losers. Exit strategy: letting go at the right time. The system told them exactly when to exit. No emotions involved. Long trades were closed if price fell below the 10-day low. Short trades were closed if price broke above the 10-day high. This let winners run until the market truly reversed, capturing the full power of the trend. Discipline: the true challenge. Following rules sounds simple, but in real life, it takes courage. Dennis reminded them, take every trade no matter what. You never know which one will be the big winner. Trust the process. Don't abandon your rules after a losing streak. Keep emotions out. Fear makes you exit too early. Greed makes you over-risk. Both destroy your edge. The results speak for themselves. Within just 5 years, the turtle traders, many of whom had never traded before, generated a combined $175 million in profits. Some achieved returns of over 80% a year, not by predicting the future, but by consistently following these rules. The turtle system proves a simple but powerful truth. Trading success is not about prediction, it's about process. So here's your action plan if you want to trade like the turtles. Risk small. Cut losses quickly. Add to your winners, never to your losers. Stay with the trend. Be consistent, no matter how tempting it is to break the rules. Because in the end, consistency plus discipline will freedom. And friends, if this inspired you, hit that like button, share your thoughts in the comments, and subscribe so you don't miss more powerful trading lessons like this. Trading is not just about making money. It's about building patience, discipline, and emotional strength. And if Richard Dennis could turn ordinary people into millionaires, there's no reason you can't do the same.